Welcome to Keen on Retirement, a show dedicated to helping you thrive before and during your retirement years. If you are looking to grow and protect your wealth and want to make the second half of your life the best half, then listen in as Wealth Advisor Bill Keen sorts through the key issues that you need to know in a lively and candid way.
Hello, everybody, and welcome back to Keen on Retirement. I'm your co-host, Steve, and I've got Bill and Matt with me. As always, gentlemen, how are you today?
Well, we're doing really good, Steve. As usual, most days we come on here, we're all doing well. Certainly have bumps in the road along the way, but most of the days when we get on with you, maybe it's you that causes us to be doing so well.
That's right. Maybe I'm the common thread here that makes you guys have a great day whenever you see my smiling face.
That's right. That's right. So, hey, I know we're coming up on tax season here. Well, we're in tax season. We're not coming up on it. We're squarely in tax season. But I was going to ask you two gentlemen, that all the buzz right now is AI is helping folks do their taxes. Are you two allowing AI to do your taxes this year? I mean, this would be cutting edge if you were. What do you think?
I am not.
I'm still a delegator. So there's a handful of things in life that I don't enjoy. One of them is shopping for a new cell phone, shopping for a new car, and doing my taxes. So I'm happy to delegate my taxes to an outside firm. And actually, I just did that a couple weeks ago where I sat down and I got all my documents together and I went online and I uploaded all my documents and got the confirmation that they received it. So now I'm waiting for them to get back to me and tell me what we need to do next. So no, I'm happy to delegate my tax prep work.
Yeah. I mean, I haven't heard of any clients that have gone that route yet. And I don't think any of them are going to. And if they asked us, of course, we'd tell them not to. Funny enough, I saw an article recently that had, interviewed some people that asked AI to do their taxes. And one of them was actually pretty funny. There was a person who decided to have the big three AI agents kind of each, I guess, do their take on filing his taxes or providing, their analysis of his tax situation. And then he pitted them against each other somehow. So he must have just told them, well, so-and-so says this. And he said they started arguing. Those AI bots kind of said, well, that one's hallucinating. Like they were telling, one of them was wrong because it's hallucinating.
It's the battle of the bots.
Yeah. I guess they've got brand loyalty. These bots, they're not autonomous yet.
Well, the other thing I saw too, though, Matt, was that that they're picking up numbers wrong.
Yes.
Especially off things like K1s and some of the more complex.
Can't read them correctly.
Documents. Yes. So,
that and even just giving telling people what they want to hear, like you qualify for something you don't qualify for, because that's something too that I've seen, and not all of them have even the tax changes that were passed last year. We're 9 months into this from those tax changes. It was summer of 2025 when they were passed, and still doesn't know the rules. So, accuracy can be difficult when it comes to AI sometimes.
When you said the big three, is that like Google, Gemini? Again, I don't want to say them here because I don't want to encourage anybody to go do this. But
there's I would. Whichever ones you think of, but those are the ones they're discussed probably the most in the media.
Like ChatGPT, Google, and Gemini, and I don't know, another one.
Yeah.
Okay.
Claude, I think, would be the other big one in there.
Yeah.
Claude. Okay.
Anthropic.
What I would ask is, if you have AI do that, who's liable for the bad advice? I'm afraid you would be, as the taxpayer.
I think the IRS is pretty clear on who's liable.
I don't think you'd connect them with Claude and have them work it out.
Yeah, you're paying them for the mistake because you filed it wrong.
Right.
One of the interesting things that I think comes out of this is I've had a lot of conversations in the past couple of years, as I know you guys have as well, about AI and about the pace of development and how fast things are moving there. And in my line of work, we like to talk about how things are changing so fast and you've got to be prepared for this, that, and the other thing. And a conversation I had here recently, we were talking about, okay, how is this going to impact, let's say, the financial advisor profession? Sure. And the comment was, I think the adoption of AI is going to move at the speed of trust. And I thought that was a really important insight. And what they meant by that was that, to your point here, it's hallucinating when I asked it to put together my taxes return or to do some tax work for me. And so we don't trust it yet. And so this adoption of AI for certain high consequence situations might actually be slower than what a lot of people expect if we don't trust the output. And so I think it's going to take a while for humans to trust AI in certain high consequence areas. And so that's just something I think to keep in mind here.
Yeah.
Well, I did too.
And bias too. I mean,
right.
Oh yeah.
Are these truly unbiased or not?
Right. You talk about, I would kind of in jest asking you if you two had used AI. I guess the question we should ask is to our CPAs and our tax counsel. Are they using AI in their firms to do some of the integrated work?
Yeah.
Think about it back when I got in the industry, Steve, you too, and even Matt, even you youngin', you've been around for almost 25 years now.
Yeah.
We didn't have the softwares we had today.
No.
So, and there were people running, including myself, early running things on spreadsheets, financial planning on spreadsheets. So at what point did you start trusting just basic software packages? Early on, you had straight line interest. You didn't have Monte Carlo or statistical modeling. That all became, we got comfortable with it. We use it. We put the human touch on it. I'm going to be giving a keynote talk for a company doing their annual convention here coming up in a few weeks. And they are a service organization. And one of the things they have is they have relationships with people, right? Their whole business is around serving people. And I was considering how my talk's going to start, but whether it starts here or whether it's just integrated into the session, I know we've talked on here maybe in the past or at least offline together about Jeff Bezos when he said, Steve, this triggered me to say this when you said all the things that are going to change, right? What all is going to change? Everyone's obsessed with everything that's going to change. And remember when Bezos came out, it's actually been a number of years ago now, and said what he's more worried about is what won't change. And for Amazon, it was more choice, lower price, faster delivery. Actually, I think you did mention this maybe 4 or 5 episodes ago, Steve. Yeah. I think you did. And so when I think about our industry and any industry that you're dealing with people and the client and the human relationship, what won't change? What will not change? And I believe that's people want relationship. They want to be heard. They want to be understood. They want to trust, which is what you just said. We all have passions. We have people we care about and love, and we all want to have a purpose. And they want a human that can relate to that and have empathy around that and help them achieve those things. That will never change. So we can be more efficient in the background, analyzing data, maybe, right? Of course we can, ultimately. But those are the things that I think will never change. So AI will hopefully help us be better at that, but that doesn't remove us or the human relationship.
Right. That's right.
Certainly. So, well, good. Well, not to make the whole episode about AI, but it is interesting because we do have another couple interesting topics to talk about. One being what we're seeing geopolitically, which has some folks concerned. But before that, I saw something interesting come up here. And, we talk on our program a lot, Matt, when we speak about regulations that come out.
Yeah.
We've always said this over the almost 11 years now that we've been doing this. We don't like to talk a lot about things that are just being proposed, but then we go ahead and talk about those anyway.
Yeah.
We like to talk about things that are in law, right? In practice. Sure. But this was something that's being proposed. I don't know if you saw this, but did you see that there's a proposal now to get rid of capital gains tax, not only on home sales, but also on properties? It even said it could go as broadly as just property in general, like real estate in general. The waiver of capital gains tax right now, it's if you're single, 250,000 capital gain, no tax. If you're married, it's 500,000. no tax. They're talking about removing any tax on primary residences, possibly secondary residences, and possibly even other pieces of property. What's your take on whether or not that'll go through?
I mean, it's probably not likely, but never say never when it comes to legislation. But it is interesting concept because it's like, okay, well, what's the objective of waiving the capital gains tax on, especially, you think about it in the context of a primary residence. I mean, you already get a portion of it tax free. I mean, whatever you paid for it is not taxed. So it's over and above what you sell it for minus what you paid it for. And if you're married, that's $500K before you were even subject to the capital gains tax. And then it's only on the amount over that you'd have to pay that.
Right. That's right.
I don't know how many, I have not seen any data. This would be interesting on how many people actually pay capital gains tax on primary residences because of, the appreciation in their homes. Probably more common on the coast than it is here in the Midwest, but it definitely could happen.
Well, let me just ask ChatGPT in real time and see what it says.
Okay. Yeah.
So Steve, if you want
to, you have to ask to cite the source of the data of when it was.
Okay. So this is a real time experiment here. So we'll see what it says.
And Steve, this is Representative Tim Burchett, Burchett, who put this forth. Tim Burchett.
Yeah.
And he says, when you tax people less, they don't stick it in a doggone pillowcase under their bed. Things move and get reinvested. That's his.
Yeah. So that's like the purpose of it, I think, is just, well, if someone is not selling this property, whether it's real estate or whatever property would qualify for this, because of the capital gains tax, and they could do something different with it, and someone else could buy it and, again, invest and do whatever they want with it. That is economic activity, which is good because you don't want to stifle that. You like money moving around in economic activity, which in a sense can generate different taxes and offset this, this loss of revenue by not having the capital gains.
Imagine if this came out, because I mean, it does say it potentially including second homes or investment properties. Now, that's a whole nother world there because there's
a lot there. Yeah.
And I know Ted Cruz came out and said something about, okay, maybe not that, but at least indexing the capital gains that we've already talked about, the 250 and 500 with inflation, maybe that's something that might be more palatable for folks to consider there as they're voting. What do you find, Steve? Did we buy you enough time there, buddy?
Yeah, you did. Yeah. So here's what ChatGPT is saying. It is saying that the best available data suggests a relatively small minority of homeowners, roughly 5 to 10% in a given year, actually pay capital gains tax when they sell their primary residence. Okay, and I asked it to give me some sources here. The key data points: a Brookings analysis cited by Investopedia finds that about 95% of home sellers owe no capital gains tax, implying 5% do.
Okay.
There's a CoreLogic Kiplinger report shows about 8% of home sales exceed the IRS exemption threshold. Well, that doesn't tell us who owes capital gains. A Yale Budget Lab analysis estimates approximately 10% of homeowners have gains above the exemption. And so basically it's saying 5 to 10%. And it varies by location, of course. California, Hawaii, Washington, D.C., Massachusetts, and Washington State would be the places that are most likely where people would have to pay some capital gains.
Okay.
Yeah.
Okay.
Yeah. So 5 to 10%. Yeah. I think seems reasonable.
Yeah. Interesting nonetheless. But it's one of those things where it's like, it doesn't, well, here's what it doesn't do. It doesn't change, like, the overarching issue with housing is that it's expensive. So especially for those that are the first time home buyers, affordability has become an issue, and that's part of its prices. I mean, just because someone's getting a tax-free sale now and maybe otherwise wouldn't, I don't think they're going to change the sale price because of that. because that's their personal tax situation is they deal with that, not necessarily the sale price. So that doesn't change the pricing. And then two, most people finance their first homes and interest rates aren't going to be impacted by this either. So that doesn't change the cost of a mortgage on that property. So doesn't address those issues, more so maybe, okay, if someone wasn't selling because of the tax, then maybe that helps.
Right. That's a great point. And Matt, Steve, you mentioned that kind of offline organically earlier about what's holding people in homes right now, or the interest rate they have on the mortgage, right? 2 3/4
for many.
Yeah.
I mean, I know some folks that have 2 1/4 on their 15-year, mortgages that they took 5-6 years ago.
Yeah, that'd be something if they could come out with a way of making your mortgage portable.
Oh, maybe we were onto something here, Matt.
Well,
yeah, I don't know how the banks would figure that out. That'd be a little complex.
Yeah. Well, we used to have assumable mortgages.
Sure.
Back in the day where, but not much of that anymore. Or maybe let's get the government to buy down your interest rate.
Oh, man.
How about that?
Well, they were kind of doing that when they were with their open market activities and keeping interest rates low during
that's
quantitative easing.
Oh, yeah. Absolutely.
So,
that would
in a
be
way,
one way to do it.
Yeah, that's right. That's right.
Well, all right. Well, we'll keep our finger on that pulse there. Again, like we said, it's just a proposal right now. So if something like that were to come out, of course, we would be implementing that in all of our planning and bringing it to our program here and keeping folks on alert there if that were to ever come through. I think with what we're seeing, we started the year with this correction in the markets, but not in the broad markets. We saw a correction this year in the tech sector, and we saw a correction in what they're calling the software segment of equity securities. Again, related to AI too, right? I mean, that kind of ties back to the first thing we were talking about to open the program. They thought this software as a service program companies won't be as profitable because the AI can replicate those things to some extent, and it brought those sectors down. And then we had what we're dealing with for the last 3 or 4 weeks here now with the situation in Iran, and all of what we're seeing there can be scary for folks to watch the news networks and see what's happening.
Yeah. I mean, when you hear these headlines, it can be scary because, like, right now, I mean, the headlines are, okay, there's a war in Iran. There's oil prices, which have gone up 70% this year. Right? When you're speaking about this, you've got this fact that, as you mentioned, software stocks have crashed. In the private investment world, there's this. I would say it was sort of popular, a little bit more mainstream. A thing called private credit. So these are companies that aren't publicly traded. They're not accessing the debt markets like a public company would. So there's private lending that can happen. Doesn't necessarily mean they're more risky. It's just different. So you had issues now with private credit, and what's happening kind of in that market is because it's private, it's not necessarily, those investments aren't as liquid, and some funds are restricting withdrawals because a lot have come in and they can only handle so much based on how they're structured.
That's right.
You've got inflation too, which part of it is tied to oil prices. Inflation hasn't necessarily tampered as much as the Fed would like. So then the odds of them making significant cuts this year has decreased, at least when you kind of look at what the futures market looks like. And yields have come up a little bit too. So just across the board, like government bond yields. So you hear all that, and the media is always talking about it, of course, because anytime there's bad news, that's going to be more interesting than telling them, well, the markets, it's still only down less than 2%. So the overall market, you hear all that stuff, and the overall market is down a little bit. And it's because of, there's certain areas that are impacted by these issues, but not necessarily every single company across the board.
That's right.
What you kind of your point there. Yeah.
Yeah. And I want, anytime we're talking about news of the day or week or month when it comes to the economic markets and the geopolitical issues that we're seeing. We're not trying to be dramatic about that. We talk about these things because, remember, in the context of someone's lifetime plan over the course of 10, 20, 30 years of retirement, or someone that's just starting to invest, so a 40, 50-year time horizon, or even multi-generationally, where the resources you have will be passed on to your children, and it could be much longer even. The key to this thing is having a financial plan in place where we're looking at all the aspects of a plan, and the investments are just an engine to the plan. The investments do need to work. They need to work long term, and there will be times where we go through, markets are up 3 of 4 years. The advances are permanent so far. The declines have been temporary. So we're not trying to be alarmist, but sometimes people like to hear us chat about what we're seeing and what we're thinking about current events. We don't do it as much because we realize that the bigger picture is a longer term plan, but still diving into current events from time to time is a reason. We do it because most folks, if not all, have a good portion of their resources invested in the capital markets. And that's why we talk about it here. Again, not to be alarmist, but just to have a dialogue, which is what our program is actually designed for, is to look behind the curtain at what we are as professionals talking about. And Steve, I think you recently had the privilege, was it on the Barron's podcast that you co-host?
Yes.
Yeah. So you're such a consummate pro in our industry. Steve hosts something called the Barron's podcast. You had Liz Ann Saunders on, right? I'll let you go ahead and share what you all talked about. She's one of the heads over at Charles Schwab.
Yeah, so she's the chief investment strategist at Charles Schwab, and we talked about like what is going on in the markets and the economy and geopolitical and everything, and what might the potential impact of all that be on the markets. And what's among many things that's interesting about her is that she's not someone who makes predictions. That's not really her role. Her role is more about trying to assess, interpret, and just really think about what are some of the bigger picture items that are happening and how do we use that to frame how we think about investing at any point in time. And one of the things that she had talked about, and really to your point here, Matt, a moment ago, is she feels that we're in an era right now, a little bit unlike, say, the previous couple decades or so, where we would have like a big recession.
Sure.
She says now it seems like it's more like rolling recessions, which means at any given time, there might be a sector of the economy that's not doing well, but that's being offset by some other sector that's doing really well. And I think an example right now would be that we've talked about. There are certain software stocks that are getting hurt by AI, but on the other hand, there's a bunch of AI stocks that are doing really well because of AI. So if you look at it on average, things are looking reasonably okay, but at any given sector, it might be, that may be down 10%. And so this idea of diversification, which of course we talk about, is, sometimes, and this also relates to international investing, which she talked about as well, that we do talk about the importance of being diversified, and that would include, going outside of the United States to diversify. But the markets outside of the U.S. in recent times have not done as well, although the last 2 years they've outperformed. So she's saying it used to be when we talked about international diversification, we'd have to say, I'm sorry. But she says now we can say, you're welcome.
That's right.
Because there are various factors happening now where international seems to be doing well in addition to the U.S. So really, really enjoyable conversation to get a bigger picture perspective on how to put what's happening now in context of the times.
Yeah, Matt, and when you see how that affects some of the work we do at our firm, how we've been allocated. Look, we're like I said, we're working on our mission, and our call from our clients is to take the resources they have to help them make that last the rest of their lives. So we're not going to get sucked into the shiny object. In my book, I call it a flash in the pan. In the second edition of Keen on Retirement, after COVID came out, and then after we had the meme stocks, remember, I felt that it was really important to add a chapter on do not get caught in the next flash in the pan. So as we will not get pulled into putting all our eggs in one sector or getting sucked into anything, we're going to be deliberate and disciplined. And so that's played out, continues to play out well for us, Matt, with the rotation back to what we call more value type type holding and those kind of things, hadn't it?
Yeah. I mean, over the last, decade probably, or you could probably even go back a little bit farther, uh, it, the overall market, when we talk about that, like generally it's like the S&P, occasionally the Dow gets kind of thrown in there, but the S&P's 500 companies, roughly that make up the benchmark there that's discussed on the media. So that's kind of why we talk about that one, because the media always talks about the S&P. And they quote the Dow whenever it has these big swings because the point swings are so big. They're always talking about the Dow was up 1,000 points or whatever, because it just sounds more dramatic than talking about percentages, or the fact that the S&P not nearly as high of a point value as the Dow, well, moved 50 or 100 points. Well, that doesn't sound as bad or whatever.
Right. Well, when it's 47,000 or 50,000, 1,000 here and there, I'm not downplaying it. I'm just saying
but
it's just a number.
Percentage wise, that's what it's like. Convert everything to a percentage. Quit talking about points.
Yes.
But that's not our call here. But anyway, the tech sector as a whole, so that includes these software stocks. I mean, everything that basically kind of falls into that, has performed really well. There's been a lot of capital kind of flowing into that sector, and it's become a larger and larger component of the S&P, because the way the S&P 500 is constructed is the bigger a company is, and they measure this by a metric called market capitalization, which is its number of shares outstanding times the share price.
Mm-hmm.
Very, very simplistic calculation, but they call that the market cap. And the S&P 500 weights all the companies in their index by market cap. So the bigger a market cap, or bigger a company is, essentially is another way of saying it, the more impact it's going to have on the S&P 500. So that, as tech became just a bigger and bigger sector, that became a driving component of the performance of the S&P 500, whereas the other sector that's representing the S&P 500, like utilities, well, that just isn't one that sexy of a sector to begin with, and two, it's really it's a regulated monopoly. It's not really designed to be this big growth engine, but it's in there. There's stocks that are in there. Well, this year utilities are up 10%. As of us discussing this, and tech stocks are down 3% just overall. Now, of course, you've got pockets like we discussed that are down more than that within the tech sector, but it's just interesting kind of that dynamic. And that's where diversification comes into play. And now, we're not saying you should own as much in utilities as you should in the tech sector, but just the concept of you don't just own one over the other. You own a little bit of each. That's basically what diversification means. And there's weightings that go into play there, and evaluating what the earnings potential are of those underlying companies and things like that. So it's more to it than just just trying to match the S&P, because we're going to go through periods where the makeup of the S&P is going to hurt its performance, because it's weighted in such a way that, hey, if tech really does struggle for the next several years, the S&P is not going to perform very well. That doesn't mean that there's a big problem in people's investments, or they should panic and get rid of them. But it'll get the attention of the financial media, because they're going to be talking about, well, the S&P is not doing anything, or it's going down, or it's this or that, and it's like, but that's not the experience of someone with a diversified portfolio. And we had, I think they called it the lost decade, from 2000 to 2009. The S&P was flat.
Yep.
The performance of it. And, we've done various studies on this, but if you were diversified, I mean, you can kind of look at, there's this thing called the Callan chart, and they kind of show this colored boxes about different asset classes, and a diversified portfolio over that period was positive. And I mean, I've seen numbers between 5 and 7% over that period. So you've got a component of it that was made zero, but that doesn't mean an investor made zero.
I talk about looking in a rearview mirror, driving forward. You would never get in your car, look in the rearview mirror, and drive forward thinking that was going to work. It might for a little while, and then until it doesn't. So when you're looking at what did best over the last time period, and then gosh forbid you put all your money in the thing, you started chasing these asset classes.
Yeah.
So that Callan chart you mentioned, I've used that a lot in my 34 years of industry experience here, where it almost looks like a quilt. We would call it the quilt chart, was another word for it, because it's each asset class had a different color, and it would show you along the top who did best a certain year and all the way ranked to who did the worst. And you would look at it and you would try to find some sort of a pattern, and there was no pattern there. So the key to it was, let's have some of each, and let's be smart and prudent rebalancers, and let's harness the cycles instead of being whipsawed by the cycles. Right? I mean, that's the concept. You got your pool of assets that's a lot of cases is your life savings. You're needing to make it last the rest of your life. Let's not be chasing what did best last year or chasing a shiny object. Let's have a real plan that we can execute on with discipline. And it's just worked over time.
Yeah.
It's worked over time.
Yeah. And these things come and go, and they might last for years. Some of these themes, like, as I mentioned, tech's been popular. In that period of that lost decade that I mentioned between 2000 and 2009, well, the hottest sector was emerging markets. I mean, for our listeners here that maybe are paying attention to some of these different asset classes, I mean, when's the last time someone's talked about emerging markets?
Right. And what would that be? Brazil, Russia, India, China, things like that, right? They called them the BRICS at one point. There's others, of course.
And there's this whole narrative around, well, this is where everyone's, moving up from, maybe from low income to middle class up to wealthy. And so there's a big, transition and a lot of opportunity there. Yeah, sure. It sounds good, but that asset class has not done much over the last 15 years. Mm-hmm. But before that, I think it had averaged at 20 or 30% over, a period of years before that. So, and everyone wanted to own it. It was all in the 401k plans. Right. I mean, it's just, people they chase those things. And then all of a sudden you had 2008, 2009 kind of reset a lot of things. Yeah. And, they didn't struggle. They struggled. Things just kind of changed. And it doesn't mean emerging markets aren't going to be a thing. Like Steve just said, international, which includes emerging markets, have been performing better as of the last couple of years.
Yeah. I mean, last couple of years, they actually have, though, right?
Yeah.
Yeah. They have done well. Yeah. International's done well the last couple of years.
Oh, yeah.
And some of that is due to currency translation as the dollar's gotten weaker over the past year or two. That has translated into higher performance when you do the currency translation from an international investment. One other thing I want to touch on in line with what you guys are just talking about here, with how sort of chasing the shiny new object and that sort of thing is, and this taps into something that Liz Ann said as well, is let's say we go back 50 years ago. Mm-hmm. And you think about what were your options to put your money to work? Well, we had sort of all the traditional stock investments and bonds that we have today, of course. Mm-hmm. And we had a little bit of gambling. Okay. We had Las Vegas. If we wanted to gamble, we could go to Las Vegas, and maybe it was the early days of being able to have a casino on an Indian reservation type thing that was maybe starting to happen at the state level. Yeah. But if you flash forward to today, it's so different in that gambling is everywhere. And she brought up this point. She said, investing is about owning and gambling is about hoping. And she tied that into the markets, meaning a significant percentage of the trading activity that's happening today is driven by just pure speculation and pure gambling. So whether it's, if you think of YOLO investing, you only live once, and sort of born out of the pandemic area, there was a lot of that going on. Today, we've got these prediction markets where people can, speculate on, how many times the president is going to say something in a speech, or what Elon Musk is going to tweet on X or something like that. Mm-hmm. And it's just kind of crazy when you think about that. And so, again, one of the key values of a financial professional is to help you tune out all of that noise, and to some extent just get back to the basics of what is solid, what is true, what has worked historically, and what do we think has a very high probability of continuing to work going forward. And that is about diversification. That is about investing in companies that generate profits, that have cash flow, that pay dividends. And those are the things that we don't see anything on the horizon that is going to make those things not continue to work going forward.
I believe it. And from my 3 decades plus in the industry, I'm not afraid of. So I am not afraid of what you just said. All the gambling, the speculation. Now that's always been there, right? There's always been speculators out there in the markets, but I'm not afraid of that, because what it does is it creates opportunity. I don't know if you remember the quote from Warren Buffett. He said, in volatile times, in difficult times, it's where stocks are returned to their rightful owners. Do you remember that? Where people are out there, they're chasing their tails, they're anxious, they're making trades on emotion. And if you have a discipline and you got a thoughtful, intentional way of managing money, that doesn't affect us as long-term investors. Oh, there's maybe a little more volatility, but it doesn't affect us. We have our models, we have our parameters, and we stick to them. I really do believe it. All the gambling apps, I don't know if you even really mentioned that, like they're becoming legal across the country, on sports and everything you can possibly imagine. And it's, I don't know, anyway, a whole nother podcast there, but it doesn't, whether that affects stocks or not, whatever, but people just getting hooked on having to, every single time they watch a sport, they've got to bet down. That can't be healthy relationships.
Right.
Personal relationships, It's like, wait, what do you care about whatever offshoot football team you're watching or basketball team? You never liked them before. Like, wait, I've got $10 on it. Tell the kids I can't see them right now. I got to watch the end. I'm not saying I do that. I'm saying that can't be be But anyway,
mindset,
again, different.
And along those lines too, I do want to also point out that it's not like things don't change, right? I mean, the markets today are very different than the markets were 30, 40 years ago. And again, going back to Lizanne for a second, one of the questions that I asked her, so she's been in the business since 1986 is when she got in the business.
Wow.
And so she's seen a lot of change. This is, way pre-internet days as well. And I said, what do you think? Is it harder to be a successful investor today than it was back in those days when you didn't have all this information, you didn't have the internet, you didn't have everything at your fingertips? And her answer I thought was really interesting. She said, I think it's harder to be a trader today, but I don't think it's harder to be an investor today. So she made a very clear distinction between, as a trader, information is everywhere. It's in nanoseconds. There's so much competition to get that, fraction of a point and billions of dollars in high-speed traders and everything. She said, I think it's harder to be a trader, but I don't think it's harder to be an investor. And it may be, to your point, Bill, that the people who are the traders create the opportunity for the people who are the investors. And a lot of that has to do with your time frame. Let's let the traders duke it out. Let's let the trading bots duke it out for nanoseconds and for micro changes in prices to make a fraction of a penny on a trade and do that 1 million times a day kind of thing, versus investors who can step back. We've got a longer term horizon that we can look at. We can look at fundamentals. We can look at trends. We can look at, what's happening and what may change, what may not change. So it may be the same to be an investor today, a long-term investor, as it was 30, 40 years ago, despite the massive changes in the environment and the economy and the world that we've seen over the past several decades.
Yeah. Well, successful investing is like, it's boring. It shouldn't be.
It's watching paint dry.
Exactly. That's the famous, another Buffett quote, right?
That's right. That's right.
It's not about pulling it up all day, every day and seeing what's going on. I mean, if you're doing that, because we do talk about that, like if that is, that's an issue, because you shouldn't be doing that. Like, I think the reason why the 401k has been so successful for most people is because it's out of sight, out of mind, and you're not even really paying attention to it. Put money in. Yes, there's certain things you have to do, make sure it's allocated correctly and you're saving appropriately in the right buckets, but it's not, you really aren't getting as many updates on that. I mean, you could probably log in and get the app and do that, but people don't seem to as much as they do with, other types of platforms or accounts that they have. And it's because it's just out of sight. You're not paying attention to it, and it works. And that hasn't changed, right, Steve? I mean, that's kind of to Liz Ann's point. I mean, that's always been the case. It's just kind of set it and forget it, to an extent.
Yeah. And speaking of Buffett, now that he's retired, we should probably do a retrospective honoring episode of Warren Buffett, just to talk about some of the the key ideas and wisdom that he has developed and shared over the years. I think while he's still alive, I think that that would be fun to do and cause us to go back and really pull out some of his gems of investing. And what also might be fun is to talk about which of his ideas have aged well and which of them he's changed over time. Because let's face it here, when he started out as an investor in his early days to where he finished as an investor is pretty different. He has evolved significantly as an investor over time. And I think it would be interesting to look at the evolution of Warren Buffett as an investor over time and where he landed today and where he is today as an investor, if that we think is going to continue to be a successful strategy and methodology in the years ahead. So I think that'd be a fun episode to do.
Yeah.
I love it. I can save this, I guess, for the episode, right? But yes, he evolved, but I would say he was not an early adopter on his evolutions.
No?
He watched things, he learned, and maybe he did shift his thinking, but he wasn't on the cutting edge, and he still was very successful by getting his sea legs around the changing of his thought processes. Would you agree with that?
Yeah. I would say two things. One is, yes, I'd say that's true, but I'd also say there were certain areas where he was early to it. And I'm thinking of like Coca-Cola as an example. And one of the reasons why he invested in Coca-Cola many years ago was he really understood the power of the brand and how people were connected to the brand and how they had such a strong connection to Coke versus Pepsi. And so, I think he invested in Coke, like I want to say in the early 80s, maybe even earlier than that. And it became one of his most successful investments of all time because over time, people began to recognize the value in a brand. And so I think in that case, he was a little bit early. But to your point, Bill, other things like technology, he would say, outside of my circle of competence. And so he wasn't investing in that early on, although later on he bought Apple Computer and did quite well with that. So I think he was insightful enough to know when I want to be early on something because I can see something that others can't, or at least believes he sees something that others don't, versus I'm going to wait till the dust settles and I'm going to see who some of the longer term winners are. And then I'm going to jump into it. And I think Apple's probably a good example there. Yeah. Waited till the dust settled, bought Apple, and still made a significant return on that.
Yeah. Yes. Yep. I love it. Well, I'll look forward to that episode.
Yeah. That'll be fun.
That'll be good.
Right.
Do you think he's doing anything different now that he's retired? Is he
still running the
show? Not reading 500 pages a day now? Is he only at 250?
Yeah. He's got AI. That AI is now giving him summaries of everything.
Yeah,
that's right.
I doubt it.
Believer there. Yeah,
yeah.
Matt, I know that we enjoy these so much, and we love sharing our thinking with our listeners and viewers. You had brought to our attention some really good data. It might be a good way to close out the episode today on how markets have actually performed during geopolitical disruptions.
Yes.
And would you mind, even if it just took a couple, 2-3 minutes maybe and talked about that? Because I think it could bring some, because look, we do not know, we don't have a crystal ball on how this will play out, what we're seeing now over in the Middle East, but we know that it will play out. I remember the towers coming down in 2001 in the industry. You thought at the time it would never play out. It plays out. So if you could share a little bit about that, I think it gives some historical perspective and I think it could be helpful.
Yeah. And really, I mean, the way we have to look at these things is that while the situation in Iran, I mean, it's serious. There's no discounting that whatsoever. But what we're trying to figure out, and this is where our analysis really focus on is there going to be significant damage to the U.S. economy, which will impact stock prices ultimately via the situation that's happening there? I mean, yes, oil is higher, and that is going to impact inflation. It's going to impact costs, and that is probably going to change the Federal Reserve's policy on interest rates. I mean, that's kind of what the market's been pricing in right now. But will it have a significant enough impact to hit many sectors, not just one sector? Like, energy stocks are doing really great right now because oil is higher.
Right.
like we said earlier, some of the tech stocks and even the subsectors within there, they're struggling. But earnings, by and large, during Q1, I mean, they've been coming out, and we have data that comes out on this, and earnings growth has been double digits. So far, earnings have been there, which is the ultimate driver of stock prices is earnings. So everything that we look at's in that context. Now, we do have history as a guide to this, because this isn't the first time there's been a geopolitical event that has gotten investors' attention. And we can go back and look at, well, how has the market performed in 6 months, kind of post some of these events, or 1 year post some of these events. And Vanguard, they're one of our research providers here, and we use a few of their ETFs inside our portfolio. And in some of their analysis, they looked at various events like the Iraqi War and the first Gulf War, Brexit, then more recently Russia and Ukraine, and even the Israel and Hamas war that we had. Now, of course, Liberation Day, the most recent one, and returns 6 months kind of post some of these events, 8% on average after the event. So higher forward returns in the 6 months after, and then 1 year later, 12.9%. So while there might be some volatility around the event itself, those events, again, if they're not having a significant impact to the economy here in the U.S., then they go away. Because that's not going to drive stock prices in the long run. What happens over there? It's more of what's the overall impact, and is the economy weak to begin with? Because usually, like these things like oil shocks, I mean that can get a lot of people's attention, because it's like, well, if everyone's having to pay more for oil, that's less money they have to spend on other things. And
it is the most tracked price in the world.
Yeah, well, because you drive by a gas station every day, you know the price of it.
You're going to be reminded of it, and it even got my attention. It did. A couple of days ago, I filled up the SUV, and I was like, "Oh, okay." Well, look, we're just back to where we were a year and a half ago, though, on prices. By the way, on gas prices. Yeah, but it doesn't matter. It is higher than it was, a month ago. So, not downplaying it.
Yeah, it gets your attention, and so then it's like, okay, is that in and of itself, though? Like high oil prices has never been this recession causing event. Is there something else going on, and this is just another factor? And that's, is the economy weak? Are we seeing significant amount of job losses? Are we seeing earnings decline, not growing, but actually declining on a quarter-over-quarter or year-over-year basis? And then you couple that in with higher oil prices. Yes, that can have an issue, but in and of itself, that's not necessarily going to be the issue. But again, that's why we have to monitor all these different factors, because they change too. They change as data comes out, and we make adjustments as necessary.
That's right. No, I thought that would be helpful. That Vanguard study that you mentioned, some of the research we look at. I saw another one too from First Trust come through, and it even went back to like Pearl Harbor.
Oh yeah.
North Korea crossing the 38th parallel back in 1950, and the Cuban Missile Crisis and the Tet Offensive and some of those things. And it's funny because I guess maybe since I'm older, I kind of I don't remember the Pearl Harbor attack, of course, and North Korea, but it does. You can look back over not just the last 5 years, 10 years, but literally over 100 years of things that happened, and you can see the event date, the 1 day returns, the 1 year returns, the max drawdowns. I mean, we look at all these things, and it what we do know is that it always, like we said, it always plays out, and look how much higher we are today than we were, gosh, even in 01 when that particular the towers came down. Matt, you also mentioned here before we went live that we're close to the market bottom anniversary of the 2009 financial crisis as well, aren't we?
Yeah, that was early March. I think the official date was March 9, 2009.
Yeah.
And that's, again, it's like that's what everyone's afraid of. I think, Steve, your talk with Liz Ann was kind of around that. Like, that was a very deep and prolonged recession. Market peaked in October of 2007.
Yep.
It stopped going down March of 2009.
Mm-hmm.
And it was down nearly 60% from peak to trough.
Yep.
And so I get it why people are afraid. They're afraid of, is this the start of that? That's the question everyone's asking. It doesn't really matter whatever the headline is. Yes, I mean, they're going to use the headline, but that's all ultimately is that the start? Are we just starting the next 2008, 2009 Great Recession? And,
that's right.
The data was much worse at the beginning of that. And then, I mean, we had in March of 2008, so even before things got really bad, you had Bear Stearns go bankrupt. And then what tipped everyone over the iceberg was Lehman Brothers going bankrupt. And that was in September of 2008. And then, you had everything kind of go haywire for about 6 months after that. And again, market stopped going down finally in March of 2009. But
do you know where it bottomed? Do you know where it bottomed without looking? No.
On the Dow?
Yeah, on the Dow. Where did it bottom in
It
March?
was like 3,800.
On the Dow?
I think the Dow.
All right.
No, sorry, 6,800. There was headlines that was Dow's going to 3,000.
That's right. It's 6,500. I'll just tell you, because I told you not to use computer. I used computer. The Dow, because this time.
Yeah, I didn't. I just remembered that.
Yeah, when you said 3,500, I was like, man, I finally stumped him, Steve. And then he corrected himself. Did you see that? I mean, I couldn't.
No, because that's when at that time people were like, no, Dow's going to 3,000. I'm like, well, if you buy it at 6,000, you buy more at 3,000. You're still going to be okay.
You're going to be okay.
Yeah.
So 6,500 on the Dow. Today we're at 47,000.
Yeah.
And we've been through a lot of difficult times between there.
Yep.
Look at that. Look at the power of the long-term capital markets.
Yeah.
So interesting way to kind of frame it there.
All right. Well, guys, I think we will wrap it up there. So as always, appreciate you being here today. I appreciate each of you watching and listening to this. And as always, please tell your friends and colleagues about what we're doing here. We would love for them to subscribe to the podcast or subscribe to the videos on the YouTube channel. If you have any questions, comments, observations, please feel free to reach out to us at keenwealthadvisors.com. And we'd love to answer any questions that you may have, either individually or we'll answer them on the show as well. So appreciate that. So again, as always, thanks everybody. And we'll catch you on the next episode of Keen on Retirement.
Excellent. Thanks, Matt. Thanks, Steve.
The Steve Sandusky Advisor Network and Belay Advisor are not affiliated with Keen Wealth Advisors. Opinions expressed by Steve are his own and not necessarily the opinions of Keen Wealth Advisors. Keen Wealth Advisors is an SEC-registered investment advisor. Advisory services are only offered to clients or prospective clients where Keen Wealth Advisors and its representatives are properly licensed or exempt from licensure. The contents of this podcast are intended for the residents of the United States of America. No advice may be rendered by Keen Wealth Advisors unless a client service agreement is in place. This program is intended for informational purposes only and should not be construed as advice on or a recommendation of any particular investment, strategy, or as tax or legal advice for your specific situation. Keen Wealth Advisors is not a tax or legal advisor. To determine which investments may be appropriate for you, consult your licensed professional prior to investing. Information in this program was compiled from sources believed to be reliable. Due to the constant state of data changing, we do not guarantee the timeliness or the accuracy of the information provided. Our views or opinions at the time you are listening to the podcast may be different than they were when the podcast was recorded. Past performance is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any prices that are referenced or market forecasts are as of the date stated and are not necessarily our opinions moving forward. As always, please remember, investing involves risk and possible loss of principal capital. This podcast is not allowed to be copied, distributed, published, or reproduced without permission from Keen Wealth Advisors.